Stay with us as we explore why the odds for a Bank of Japan rate hike in September have skyrocketed to a staggering 82%. What does this mean for the Japanese yen, now hovering near the critical 160 mark against the US dollar? Are central banks secretly coordinating their foreign exchange strategies, or is a significant hawkish shift on the horizon? Just a few weeks ago, before the BOJ's July meeting, the market assigned only a 23% chance for a rate hike this September. Fast forward to today, and those odds have tripled to around 82%. This dramatic shift comes as the yen struggles near the 160 level against the dollar, despite previous efforts to intervene. Historically, Japan has leaned on ultra-loose monetary policies and aggressive interventions to manage yen weakness. But with persistent inflation and evolving global dynamics, the effectiveness of such interventions is becoming increasingly questionable for both global macro funds and domestic institutions. So, what sparked this rapid change? Market expectations have shifted dramatically, particularly with key Bank of Japan figures, like Deputy Governor Ryoso Himeno and others, set to speak just ahead of the crucial rate decision on September 18. Investors are eagerly anticipating these speeches, which are expected to indicate a move towards policy normalization. Meanwhile, in Washington, U.S. Treasury Secretary Bessent is contemplating a plan that could unleash nearly $1 trillion for major bond buybacks, potentially doubling minimum purchases of long-dated U.S. Treasuries. At the same time, reports suggest that coordinated G7 interventions in the yen are unlikely without a unified statement, as the U.S. has opted to sell euros instead, reflecting differing views among G7 nations regarding Asian currency spillovers. Market reactions have been swift and sharp across social media and trading desks. Traders have identified a recurring pattern: the yen tends to weaken on Mondays. This has raised concerns about broader central bank strategies. Key traders on X are suggesting that major central banks might be coordinating FX levels and yield spreads behind the scenes. However, this has also sparked criticism of strategies that rely on yen intervention and liquidity manipulation. The prevailing sentiment in the market suggests that without monetary tightening, currency interventions are merely a temporary fix in the face of fundamental yield differentials. Institutional analysts are clear: the threshold for repeated joint interventions is extremely high. Without an official G7 statement, Japan's Ministry of Finance can only provide temporary relief for the yen through unilateral action. Analysts are now eyeing the September 18 BOJ meeting as a pivotal moment for potential trend reversals. Furthermore, if the U.S. follows through with its $1 trillion bond buyback plan, we could see significant shifts in long-end yields globally, leading to complex effects across international banking systems and forced unwinding of foreign exchange carry trades. But how will an 82% probability of a rate hike impact Japanese equity sectors? Higher policy rates typically enhance net interest margins for domestic financial institutions and major banks, making them attractive to investors. Conversely, export-driven manufacturing sectors might face challenges if a hawkish stance results in yen appreciation, potentially affecting foreign earnings. Additionally, the Nikkei 225 index and other equity markets will need to adjust to rising domestic borrowing costs as Japan shifts from its long-standing ultra-loose monetary policy. In the foreign exchange arena, the dollar-yen pair, now near 160, is at the heart of global macro volatility. If the Bank of Japan does raise rates in September while the U.S. Treasury amplifies its long-end bond buybacks, we could see the yield spread between the U.S. and Japan narrow more quickly than expected. This scenario poses risks of unwinding long-standing yen carry trades, creating ripples across global sovereign debt markets and risk assets. Additionally, currency markets are closely monitoring whether central bank coordination on yields and FX can maintain stability, or if sudden currency fluctuations will disrupt broader commodity and international bond markets. For individual investors, this period calls for disciplined risk management. First, resist the urge to chase short-term currency trends or over-leverage positions based on weekly anomalies like Monday yen weakness. Second, stay vigilant for the scheduled speeches from BOJ officials Himeno, Takata, and Misu leading up to September 18th, as their tone could determine whether the 82% rate hike odds materialize. Finally, keep an eye on U.S. Treasury yield developments and liquidity announcements to ensure your portfolio is prepared for sudden currency swings and interest rate volatility. Now, let's examine 3 potential future market scenarios based on our AI projection models. In the base scenario, with an 80% probability, the BOJ raises rates at the September 18th meeting, driving US dollar to Japanese yen down toward the 152 to 155 range, while Japanese banking stocks see steady inflows. In the bullish yen scenario, with a 15% probability, strong hawkish signals from BOJ officials combined with US Treasury bond buybacks could lead to a sharp unwinding of yen carry trades, pushing US dollar to Japanese yen below 148 and sending Japanese sovereign bond yields to multi-year highs. Conversely, in the bearish yen scenario, with a 5% probability, if the BOJ delays its rate hike due to global uncertainties, US dollar to Japanese yen could rise above 162, prompting emergency interventions from the Ministry of Finance. Investors should keep a close eye on official commentary before September 18th, as it will be crucial in determining market direction. In summary, first, expectations for a September BOJ rate hike have surged to 82% ahead of critical official speeches. Second, the likelihood of G7 joint intervention appears low, focusing all attention on actual changes in monetary policy. Lastly, the U.S. Treasury's buyback plans introduce a significant macro liquidity factor. What do you think will happen next with the yen? Share your thoughts in the comments below, like this video, and subscribe to Tokyo Macro for your daily insights.